We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Tavi Costa, portfolio manager at Crescat Capital. How are you today, Tavi?
I'm doing great. How are you, Tom?
Excellent. Good to have you back. And of course, we're speaking here on the 21st of November, and gold is hovering in and around that $2,000 level. So I wanted to start by kind of getting your thoughts on how many times we need to really test this boundary before we break through it.
Well, I think the boundary you're referring to is the triple top, and we touched it 3 times, and I rarely know triple tops that actually work. And so in my view, this is actually a perfect technical setup to see gold really breaking out and starting, in my opinion, will be a third cycle for precious metals. We've had 3 of them since the 1970s, during the 70s after the gold standard, the break of the gold standard in the early 2000s. And today I think we're really on the brink of seeing something very special for this whole industry. And it's so important to be focused on the opportunity here, because if we are indeed in this kind of beginning of a cycle for the metals, there are other opportunities that look even more appealing. You can go through silver at an 83 ratio between gold and silver, historically high would be. I've never seen a cycle for gold that doesn't actually have silver leading the way to the upside. And so you would expect some real explosive moves in the metal. And I know we've been talking about this for a while, but I do think we're getting really close to it now. And the second one would be the miners. They're unloved, underappreciated, overlooked, and I highly doubt that they're not going to be highly re-rated as well, which we tend to see during cycles too. So there are some great opportunities. It's almost like everyone is waiting for this breakout to happen. But if anything, I believe investors that really make billions of dollars in this industry are the ones that accumulate those opportunities early before the breakout and really establish themselves prior to the big move. And so I think we're really close to a breakout. And if that's the case, a lot of things are going to be re-rated much higher in prices.
Mm-hmm. So from that technical level, Tavi, what do we need to see, a really conclusive break of that level? Do we need a monthly close above that $2,000 level?
I think we need a real monthly close of at all-time highs. I think that's really what, and every person will give you a different answer. Nobody really knows what that really means, but it just, to me, it's acceleration of the price as we break out to new highs would be the very telling structure technically that we need to really bring other things into as part of this rally, meaning the capital flowing not only towards gold, but really flowing towards other things that are more speculative, but also have the tendency to move even further than gold itself during those cycles we were referring to. So there's, again, no shortage of those things. Some people may say platinum may be another one, or palladium, but I believe that the miners are probably one of the cheapest ones, and particularly the ones that are actually priced for failure currently. So it's really interesting, even the dynamics happening inside of the industry itself. We're starting to see, from more perspective of investing in exploration and developers, we're starting to see some of the majors beginning not only to take positions, strategic positions in some of our companies, but also I would say that there has been some engagement that certainly didn't happen 1 or 2 years ago. And the engagement really started with more of the battery metal related companies we own, but I would say that now it's spreading across other things as well. And so this is sort of a new phenomenon in terms of this sort of difficulty that we've had in this cycle. Obviously, as we see gold prices break out, if the miners' stock prices also appreciate, that becomes their currency, and they will certainly trigger even more M&A cycles. And we know that for a fact that most of the major companies are facing a supply cliff issue not only because of resources have not been expending, they've been mining those resources, but also the remaining quality of those have been deteriorating significantly over the years. And so there's a lot of technical issues inside of the industry itself. And, usually when you are in an inflationary cycle, you want to own businesses that have pricing power, businesses that are able to really take advantage of the appreciation of things in general. And I would say that despite the fact that cost of operating a mine goes up in an inflationary era, what you tend to see even more is that hard assets appreciate even further. Mm-hmm. And that's what really causes the reason why commodity businesses do so well or did so well in the 70s or the 40s, despite the fact that operating cost was rising. And so to me, they have inherent pricing powers because of the commodity, the link to the commodity prices. And so I'm really excited about this overall industry because I think that's going to be the place to make generational wealth here.
Mm-hmm. Tavi, when we start to see the majors come in this way and have this engagement, they're trying obviously to replace their reserves that they're mining. Do they tend to end up paying a premium for that metal in the ground?
It's a premium, but it's nothing massive. I mean, we've done a whole research on this throughout the last decades or so, and looking back in other periods that we had both bull markets and bear markets, or what we call neutral markets, and the difference between that and the takeout prices. From an exploration perspective, what we tend to see in average is that majors tend to buy those businesses for about 20% of the value of the mineral in the ground. So let's say there's a $10 billion of gold in the ground. A major would probably buy that for about $2 billion. And you can go deeper into that research and add more conservative metrics, such as how much is it going to cost for that to be really, how much dilution we're going to need to get this project into production, and other things that can certainly become relevant factors to value that company. But more or less would be about 20%. Now that 20% may change drastically depending on what type of market you're in. If you're in a bear market, it could be even lower. It could be 10%, 5%. If you're in a bull market, we've seen takeouts of about 70% of the value of the mineral in the ground. So it's so important to know that the leverage from an exploration and development phase of the industry is not only attached to the price of the metal, but also attached to what type of market you were in. If it is a gold market, not only you get the leverage of the price of the value of the mineral in the ground, but also the likelihood of being in a takeout situation where the appreciation can be even further because of the excitement that is created, the speculative environment that is created in a bull market. So it's so important also to know that majority of the billionaires in this industry made their capital investing in exploration and finding major discoveries. And it's something that we're kind of lacking in this cycle, has been finding those discoveries. We've certainly been part of a few of them. Newfound Gold pre-IPO, Snowline pre-IPO, Hercules recently was another one that became quite popular. St. Cristobal Mine is another one that we probably have a major discovery. And so there's a lot of different segments of this industry that actually perform well, but it's been very difficult to find major discoveries that became kind of new projects. And so I think we're in the process of seeing this leadership of the mining industry potentially changing because of the extra conservatism across most of the major companies, potentially causing them to fall behind and seeing some other mid-tiers becoming the new leaders of this industry. So quite interesting how that's all changing. The majors should be really taking advantage of this in a big way. And unfortunately, we're not, although we're seeing some engagement, as I pointed out before. If I was running a major, I would be engaging a lot more. I think these are depressed opportunities. And so to me, this is an incredible opportunity.
Tavi, when we see, gold miners, as you put it, being priced for failure right now, we've been seeing some gold miners kind of end up diversifying into other metals just to try to add some income to their balance sheets. Do you think that this is a net positive for the industry?
I don't know necessarily if I would see this as a net positive. I would point out specifically with gold, because I think there has been some aversion towards the metal recently to potentially spreading or diversifying towards electrification metals like copper, cobalt, lithium, and other things that have been more on top of the green agenda. And those are classic moves that we tend to see at the bottom of the gold cycle. I mean, seeing major companies actually shift away from gold production to copper production, to me, is really interesting, because when we look back in the 70s and early 2000s, one of the things that actually, I wouldn't call it trigger the bull market, but certainly coincided with the bull markets during those times, would be the global production of gold falling during those decades. And it was a long-term decline in rate of production. And we're certainly seeing the same today for many different reasons. I would say some of them has to do with the ESG policies, conservatism, the lack of focus on growth of most of the majors, instead focusing on dividend policies and buyback policies and other things. We're also seeing this shift from shareholders to really reinforcing the need for investing in green metals rather than actual gold and I would say monetary metals overall. And those things are all forcing those companies to decline production. But as counterintuitive as it may sound, that certainly was in line with the prior gold cycles that we had in the 70s and early 2000s. And I think it's painting the picture for the same to occur here.
Tavi, is there a seasonality to the gold mining stocks that can be observed as really a best time to buy?
Sure. I think there's great seasonality actually factually on in December. Believe it or not, a lot of people are worried about the fact that we may see tax selling and so forth happening across most of the companies that have not performed well. But even in a very challenging market for this industry, we actually saw December being one of the best months for this industry, and particularly the smaller names. You can also see that January and February are the second best performing months for this industry. But that's just one important factor for those looking for seasonality to step in. I would point out to another important timing indicator, which has been big depreciations in the dollar, or I should point out what I mean by the dollar, because there's many ways to measure the dollar. DXY index, when you see the DXY having a big sell-off on a daily basis, those actually mark incredible periods to be buying gold and actually marked some historical bottoms in the metal as well. So I think we're seeing some of that setup currently that looks quite attractive. Another thing to point out, I would say as well, has been the gold miners to gold ratio. When you looked at that chart itself, it's been making higher lows for a while, and now it's hitting on a support line currently, which I think it's likely to bounce and look quite attractive as well. So, I've never seen this industry as with so much skepticism across this. And so to me, this is, sounds like a great opportunity to be a contrarian investor and take advantage of a value opportunity with very compelling macro reasons to be an investor.
Mm-hmm. Tavi, what happens when there is a rotation of capital into the miners? Does the mining industry have enough stocks really to go around to absorb the capital flows coming out of underperforming asset classes?
Well, we like to joke around that this is the mining industry, as capital intensive as it can be. We'll certainly find a way to attract your capital, but we're really distressed right now in terms of valuations, and certainly a small amount of capital flowing into the space would probably make some real repricing of those assets over time. I believe strongly that I've never seen a time when the metals and mining industry have been so low in terms of the weight relative to overall equity markets. And we're in the process of seeing so many new fiscal parts of the agenda that are likely to be deploying capital into the space. I mean, think about the deglobalization trends that we're seeing with the reshoring, the revamping of manufacturing capabilities in the US and other G7 economies. This is very similar to what we saw back in the early 2000s with China becoming the manufacturing plant of the global economy, but happening across most developed economies. We have a housing affordability. Every day I look at those affordability indices making new lows recently, the first thing I think about is the government's going to have to get involved here and provide some subsidies to increase construction of those of residential properties in general. And as we see that occurring, I believe that that's going to also drive the demand for metals and mining. Let me point to other ones. For instance, the Green Revolution is another one that requires metals more than anything else. Or just the fact that we may need new airports and new highways in the U.S., which has been, if you look at public spending from a government side in terms of infrastructure, we've been in one of the lowest levels in history, or even the defense spending side of it that is also likely to help the metals and mining industry too. So I think there's, all those different policies are yet to have their impact in terms of creating demand and also making the metals and mining industry a lot more relevant. Let me give you one stat that to me, it blows my mind. The fact that Apple and Microsoft alone have about 15% weight in the S&P 500 today. That is 70 times more than the metals and mining industry. That's including precious, base metals, all sorts of metals into this calculation. It's something we've never seen before. So I really think that those big distortions are creating a symmetric opportunity for investors to take advantage of. But a lot of people are not seeing it that way. I just can't believe we're going to go through all those transitions without making metals and mining a lot more relevant in the near future.
Mm-hmm. Tavi, when we think about the setup for silver and why you guys are so positive on silver, does this create an even more asymmetric opportunity in the silver miners? Because there seems to be a lot fewer that would qualify as being of interest for you in a cycle like this because of the, let's say, the less specialized focus of silver miners.
Yes, and it's so difficult to find those silver mines that have primary production in silver itself. And even from a discovery side of things where we focus mostly, it's very difficult to find primary silver discoveries. But it's been on top of our mind because it's I think still is the cheapest metal on earth. And I can't imagine that we're going to see a gold cycle that is not going to be followed by silver really having an explosive move to the upside. And when we went to purchase the San Cristobal mine as a great example, those types of opportunities trading at single multiples in terms of free cash flow annually for the price that we pay for the mine itself, 3 times or 2 times free cash flow, depending on how you calculate it. Those things are not going to be here if silver takes off and we see a $50 per ounce kind of environment. And I don't think this is even going to happen. I think it's going to be much larger than that in the future. So to me, silver is got a very strong case from a supply side, from the demand side. I had a chart the other day showing the imports from India surging recently, which is such an important metric as well to add to this whole thing regarding it's a country that is deeply ingrained in terms of owning hard assets in their culture, although gold is what really makes up most of that. While people may say, well, this is the wedding season, there's no seasonality in this research. You can see it in the chart. It's been just surging. And while it's been actually retesting levels of 2011, it's important to know that this chart was created in US dollars, meaning in terms of ounces, we're seeing something that dwarfs that amount that we had in 2011. So that's just one example. Look at production of silver from Peru or from Mexico. They've been declining historically. And we know for a fact that, discoveries of the metal have been not as great as we've seen in other periods in history. So the lack of discoveries themselves is another great timing indicator for the metals and mining industry. But to me, the supply case is very strong. The demand case, to me, is one of the strongest I've seen. It's a monetary metal, inflationary hedge. It falls into the Green Revolution, solar panels, and other things that may create demand for the metal itself. And so, to me, it's really it's as close as it's a great opportunity. I think every investor should own a little bit, and I see it as a to me as a major focus right now.
Mm-hmm. Tavi, when do fundamental indicators matter versus technical indicators? And is there a key case in which you use either one?
Well, I'm a type of investor that likes to use everything in my favor to try to predict what the market is likely to do. But timing markets in the short term, as everybody should know by now, it's extremely difficult. So to me, it's much easier to step back, and it's why I work on those charts and those letters and kind of long-term pictures of what I think the world's going to look like 10, 15 years from now. Because I think it's a really good exercise to find and kind of think about distortions and different cycles in the past that may be used as an analog for today. I like technicals. I think technicals add another element of momentum to a trade. But I don't, I'm not using technicals necessarily to make my big decisions in terms of investing. I think the biggest decisions we make is certainly coming from a value and macro approach. Macro to me is the most important thing, because identifying those big trends that we're likely to see in this environment, regardless if it is, the electrification metals, global fiat debasement, the fact that we're seeing a redefining of 60-40 portfolios, central banks accumulating gold, they still own 20% of their balance sheet on gold. We're likely going to see levels that we've had it back in the 70s when they used to own 50, 60, 70% of their balance sheets in gold. And so thinking about that is much easier to then plan how to really deploy capital, and also how to attract those great opportunities that we can see in the markets right now. And so energy crisis is another one. I mean, I think the energy space continues to look attractive. When I see a big decline in oil prices, certainly something that catches my attention. I understand the risk of a recession, but over the next 5 years or so, I can't believe we're not going to see natural gas prices and oil prices surge significantly from here, given what's happening in the geopolitical world, and also the supply issues that we see with the energy commodities. And so there's a lot of things to be doing here. Agricultural commodities also look very attractive, but in general, hard assets are where I'm really thinking about how to structure a way of capitalizing in this next decade, regardless if it is resource-rich economies or just businesses that are revolving around those underlying commodity prices too. So all those to me look very attractive from a value perspective, from a macro perspective. And then I look at the charts and I see, a double bottom, let's say, in Brazilian equity markets versus U.S. equity markets. Well, certainly adds to the case and certainly makes me even more excited about this idea. But everything to me starts from a macro and value approach, and then technicals certainly are more complementary and definitely add to the case in a big way.
Mm-hmm. Tavi, thinking about this from the macro perspective, you have a great chart showing the commodities to equity ratio, and I think that's an excellent way to really be able to showcase that viewpoint, right? We'll share it on the screen, but is that just another case that adds to that load of data for you to convince or to make such a convincing case for the revaluation of these commodities?
Yes, and we often hear people that are investing in natural resource industries often hear that, look, I've been listening to this thesis for a long time. If I would have listened to you 10 years ago, I would have lost so much money. And I wasn't talking about this 10 years ago. I came in, I looked at this chart, I look at the CapEx chart, in which shows the producers that go through cycles. They spend capital, they become crazy spenders, and then they have insane M&A cycles and so forth, and then they go through periods where they just become very conservative. Access for capital becomes limited, and they change their management strategy, where they don't acquire any businesses, they don't invest in exploration, and this is absolutely classic throughout history as well. And so it's pretty much in line with the commodities to equity ratio. But this ratio that you're referring to me, signifies even further than just the mining industry or just the commodity space. It also means how expensive things are in a financial assets world. I like hard assets because I think financial assets are historically overvalued. And looking at equity markets precisely, I've never seen a time when there's so much speculation and valuations being so expensive historically. I don't think there's going to be a lot of returns to be made in the next decade or so in the space. And so to me, I get much more attracted to how do I make money into something that is unloved and potentially offers much better growth and value opportunities like commodities. Another thing that also shows in that chart is that value to growth transition, or the growth to value transition, where most investors have focused so much on growth investing and growth multiples and growth metrics overall, and top line types of fundamentals, that they've forgotten about profits, forgotten about margins, and all those value, kind of classic value metrics that we tend to look at when we have cost of capital rising. And so now, where cost of capital is starting to become more elevated relative to the next decade or so, the last decade or so, I would say that we're starting to see the focus shift away from growth into value. I think this is a real transition. This was not just the case in 2022. I think that what we had in that market is likely to play out again and again and again in the next decade. And so, it's going to create a lot of opportunities. There's a reason why we're seeing, for instance, there's just one example, the Fed tightening monetary conditions so much and Brazilian equity markets performing so well. What's going on? Normally we don't see those types of market behaviors usually. Or look at the Japanese yen, for instance, collapsing recently. That's a safe haven. Used to be seen as a safe haven. Japanese yen now completely collapsing relative to gold and other things. Or what's happening with the fixed income market. All those are breaks in correlations that we haven't seen in the past, decade or so. And I think a lot of people are a bit confused about those changes, and they all have to do with the redefining of 60-40 portfolios, central banks being forced to buy gold. And they're not going to all happen at once. Those things take time. Those funds have mandates. And until those mandates change, we're not going to see those correlations completely shift in a big way. So all those things happen slowly, but they're happening in different parts of the market almost every day. Note the energy performance in the last 2 years, one of the best we've seen in history. By far outperforming any other sector, even the technology sector that recently has done so well. And so, and you may say you're cherry picking that period. Not really. I mean, this is really since the 2020 decline that we had in that crash and that recession of the pandemic, the world has really changed. In which the fiscal and monetary stimulus has created a need for folks to start really hedging against inflation. And so I'm in the camp that inflation is not transitory, and there's going to be a lot of important shifts in markets. And so, to me, there's going to be a lot of ways to make money here. So I'm not in the doom and gloom camp either. But I do think this is a different market than we saw in the last 10 years.
Tavi, in your view, does this, acceleration in commodity prices end up resulting in a commensurate reacceleration in inflation as well? And what do you think can be done to realistically combat that?
Well, the irony of what we had in the last 2 weeks, for instance, where metals and mining or metals themselves are rising in prices as inflation decelerates. And so we're seeing inflation data coming in recently that, showing that we're seeing a deceleration process, but then commodity prices surge on the back of those news. How do people think inflation will look like, 6 months from now with that type of market reaction that we're seeing? Gold prices tend to lead inflation in a large way, and people forget about that because we really haven't seen inflation in a long time. And gold prices have been kind of quiet recently, but I do think that what we're seeing in the gold price is also a reflection of this need that we have from what I call the trifecta of macro imbalances. We have a debt problem of the 1940s, inflation of the 70s, and also a valuation problem of the late 90s and the late 20s. And so to me, this is a very difficult environment for policymakers to act. And therefore, they're going to be highly constrained over a long period of time, and we're likely to see inflation reemerging. And to your point about inflation, or your question to inflation, there are very important pillars here still at work, meaning the inflation pillars that I often talk about, they're still happening, and they're probably long-term ones, like what's happening with the labor markets. Think about the strikes, the number of strikes that we're seeing across the globe, not only in the US, but in Australia, in Canada, all sorts of places, because of the cost of living being so high. And even the profits from corporations, it still needs, has a lot of room to pay employees a lot more. So as we see those things feeding into the system, we're likely to see workers actually make more money over time. Another one that is very important is the reckless amount of fiscal spending that now a lot of people have been covering that, but it's been insane how much we're seeing, even excluding interest payments. We're seeing close to 25% of GDP in terms of fiscal outlays alone relative to the economy. Another one would be the chronic underinvestments in natural resource companies. I mean, that is the foundation of the commodity cycle, and we haven't seen that really being resolved. I mean, if you looked at most industries in natural resources, their capex cycle is still very depressed compared to history. There's a reason why commodities tend to have very long-term price behaviors, and so we haven't seen that in a while, and so we're probably at the very early stages of a commodity bull market. So that's another one. And I think the most important one is deglobalization, potentially, where this is a different world than we saw 5 years ago. And potentially this whole deglobalization started with tensions between US and China. Trump's agenda was very focused on that. And I think that started to unleash other issues. And now we had the Russian invasion in Ukraine. And then we had what's happening now in Israel. Don't forget Taiwan. And, so there's a lot of things that could potentially become even bigger news. I mean, we've got two wars unfolding right now. Periods that we have wars, usually also in line with inflationary times. When we had this sort of deglobalization environment, also causes countries to go above and beyond in terms of cost effectiveness to really, make sure that they have a reliant business model, logistically speaking, as well. And so we're seeing all those changes happening right now, and it's really interesting how people are still seen as disinflationary, but it's just because you're stuck in the last 10 years still. But this is a very different setup in my view, and inflation that works through waves. Remember what happened in the 70s and the 40s. Inflation developed through waves. We saw the first wave, the second, and the third, and we're probably in the process of bottoming in inflation right now. Nobody can really know when exactly the bottom is, but certainly as we see those types of headlines of metals, surging or appreciating when inflation decelerates, those types of things are really what creates and sets up the stage for a bottom in inflation over time.
Tavi, with a really horrible bond auction 2 weeks ago, how does the U.S. keep financing its debt?
It's a really good question. I've been covering the bond issuances, even in your podcast, for a long time. In fact, we wrote a very long letter in 2021 about the risk of issuances becoming a bigger problem, and the fact that supply was likely to going to drive interest rates much higher. And so here we are now. It's certainly a very well-known topic, but an even bigger topic is the fact that we have so much debt that's going to have to be issued in the next 12 months. I calculated the other day that about $8 trillion are going to be coming in the market in the next, or really maturing in the government, in the federal debt in the next 12 months. And it is a big question. I mean, are they going to just continue to issue T-bills over and over and over again? I mean, T-bills are still a small percentage of their overall debt, believe it or not. It's about 20% of the overall debt. Majority of it, about 40%, is on notes, which is the middle segment of the debt maturity. And so are we likely to see, going from 40 to maybe, to switching towards the maturity being even shorter moving forward? And if so, what are the consequences of all that? I think all these people that are talking about, T-bills and chill, I don't think any of us have a real grasp of what is likely to cause this tsunami of issuances of debt coming from on the front end of the curve. None of us have ever experienced this, and anybody who claims to be an expert on this, it's going to be nothing but chill in my view, buying T-bills. And so I think there's better opportunities. I remember back or I should say in the 70s, if you looked at the data, you can see that gold at an annualized return of about 40% during that decade. Can we see something similar today? Even if we see half of that, 20%, that makes you look stupid owning T-bills, I think it's very likely. And so especially knowing that central banks and other institutions are starting to buy into the metal as a way to diversify away from, debt maturity, or I should say debt instruments overall. To me, those are bigger questions, and I think we all know the answer for who ultimately needs to be the buyer of last resort for government debt, and that's the Federal Reserve. And so, when do we see that? I don't know. I would say my best answer for that is when things really break in terms of the Treasury market. I think we're going to see some sort of step in from the Federal Reserve. And, we haven't really seen the Fed members talk about the Treasury market with any real concerns yet. In my view, they've been actually, supportive of the move in yields recently that, according to them, helped them to tighten monetary conditions. And so, I think when we see those policymakers start actually making more reference about the risk of 10-year yields and 30-year yields rising drastically, I would say that's the time when we're starting to see also the potential for yield curve control and other things. But that's inevitable in my view, and it's the reason why I don't get too hung up on when we're going to see a breakout in gold and so forth. To me, it's not a question of if, it's a question of when. And owning assets that are historically depressed linked to gold prices, to me, is almost as close of a no-brainer as it gets. And so and I don't want to know, I don't want to really sound like I know the future. I really don't, but I do think it's inevitable that hard assets are going to have to be repriced much higher. And businesses that are linked to those things are still at very depressed valuations. And so to me, that's just one way to be invested in. And maybe the fact that we haven't seen all these issuances of debt just yet. So there's a term called effective interest rates, which is just a simple term to look at the interest payments today relative to the overall debt. And that still is very low relative to history. And as we see corporations and sovereign institutions and even individuals start getting into debt obligations at higher interest rates that we've seen now, that are set relative to a year ago, I think we're going to see the tightening of monetary conditions impact even further in the system. And that's going to be what really potentially puts us in a stagflationary environment.
Tavi, as we're talking about yields and using them as a tool, obviously we've had an inverted yield curve for a considerable amount of time now. How do we keep using this as a predictive tool of recession?
Wow, it's one of the best ones that we've seen in history. But believe it or not, we've got a profusion of macro indicators pointing towards a recession in the near term, like probably we've never seen before. The yield curve inversions are a real problem, and often it's been right every time in history. Meaning, first you see a deeply inverted curve, and then when you see the steepening of that, that's when you should be really concerned, and that's kind of what we've seen recently. And so I would not dismiss that as a macro indicator. The second one would be unemployment rates as well. I mean, it's one thing to be tightening monetary conditions with the Fed, with unemployment rates and labor markets being so robust, but when you start seeing those show signs of deterioration, that's when you should be worried. Unemployment rates just crossed the 24 moving average recently, or its 2-year moving average. Every time we've done that, it marked the beginning of either a recession or the beginning of a major deterioration in labor markets. And so is this time different? I don't think so. Or think about the consecutive amounts of declines that we've had in leading indicators of the conference board index, which to me, it's another one of those that never failed before. We've had 18, or I should say 19 months of declines in that index that only happened twice in history: 73, 74 stagflationary environment and global financial crisis. Well, it's another one to keep an eye on. Or the fact that we've had 12 monthly consecutive months below a 50 print in ISM manufacturing. That's another one. Every time we've seen that, a recession followed. So, or just another point would be how monetary tightening has been happening for 21 months already. Even the Fed put out a paper about this, saying that there's lag effects in monetary policy that tends to take about between 18 to 24 months. And this resilience in the markets and resilience in the economy is quite normal because of this lagging effect. Mm-hmm. And now that everyone is talking about soft lending being such a popular narrative in markets, again, it's another classic one that it kind of precedes recessions too. So, I can go on and on, Tom. Another one would be banking credit, right? Banking credit now contracting, for the first time since the global financial crisis, is another one to be aware of. Our trucking services, employment for trucking services is starting to contract steeper than what we saw in the early 2000s and 2008. And so I don't want to really bother your listeners, but there's certainly a profusion, as I said, of macro indicators suggesting that a recession is probably ahead. And the fact that we went from hard landing to soft landing in terms of the prominent narrative, to me, it's even more concerning.
Well, I was going to say, I have two more on my list, and that's the let's say the prevalence of people predicting a soft landing. That I think is an interesting indicator, as well as, let's say, Apple's performance as an indicator of recession as well, right?
Or Warren Buffett hoarding cash more than any other time in history, or the value destruction of the fixed income market that we haven't seen in many decades. And what are the real implications of that? I mean, who loses with that? The most are central banks. They hold most of those instruments themselves. And as we see the volatility of the bond market staying high as it has been, what does that cause? It usually causes volatility in FX markets. And how do we see that impacting equity markets, where VIX is still at a 13 as of today? And so to me, it's mind-blowing. Or the fact that credit spreads are one of the lowest levels we've seen in history, given especially where volatility of most instruments in asset classes are currently. And so, there's no shortage of things. And there's a great indicator that we look at a lot, which is, the 70-year channel that we are in the corporate earnings. If we look at the earnings per share in the S&P 500 going back to the 1950s, 1940s, you're going to see a very long-term channel in which corporate earnings, hits that upper band, and then you see a decline or a recession, economy contracts, and then we have a bottom, and then it keeps going higher. And so, we keep hitting up and down this channel throughout history. And now we're at this critical juncture again, in which, in my view, it's another one that we're likely to see a contraction of earnings caused by either margins getting squeezed because of inflation, and on top of labor costs and other things that are starting to pressure those companies to reduce their margins, and all those things are going to feed into the system as well. So there's no shortage of issues here, and to me is that adds to the gold case in a big way. And it's why I'm so excited right now with the metal.
Mm-hmm. Absolutely. Tavi, with the election of Javier Milei, or how do you say his name again?
Milei. I wouldn't be the right person to pronounce his name either.
Well, the new Argentinian prime minister.
I don't know.
Does this mean good news for the Argentinian industry and exports? And is he planning, or as he's planning, to dollarize the economy?
Well, those are big. There's a lot of low-hanging fruit in Argentina in terms of improving the economy. And certainly, I would say that some of them would be the fact that we may see the dollarization of it certainly would be a huge one. But the fact of maybe opening more of the capital accounts and allowing foreign investments to come into the country, I am a little more skeptical than the market in terms of him actually making all those shifts so quickly. I think it's going to be very challenging, although I think this is a huge win for South America. I saw the media painting this as positive for Argentina and very negative for other countries, neighboring countries. To me, that's just, it couldn't be more wrong in my view. I think that that's very positive for the whole region, and more capital flow into the system should help those assets also to perform very well, which have been historically cheap now for some time. And as we see a commodities, you should expect that those economies should do very well. Now, one thing to point out, though, is most people look at from a politics perspective rather than an economic perspective, and a lot of times the economy leads the political moves. And it's hard to see shifts like we saw recently with Argentina during a bear market in commodities. Very, very difficult to see that. In fact, that was the main reason why Venezuela became what became recently in this last decade or so, especially how deteriorated was on the back of a very, very challenging oil market and commodities overall. As we see things shifting to the upside, believe it or not, capitalism tends to take a bigger lead in a lot of policies. And, politicians, although they have a left mentality, in some cases, very communist mentality, they are not stupid enough to not allow those markets to unfold when we see a commodity cycle. That doesn't mean Brazil will shift from an emerging market to a developed economy. I just want to make sure people understand that, because it's not my view. I think Brazil is really cheap and very interesting as an opportunity in markets right now, but I highly doubt we're going to see it moving from an emerging market to a developed economy in the next decade or so. I think we're going to go back to a long-term cycle where finally, when the commodities prices actually reach their limit, we're probably going to see another really difficult period in the country. So that's just the way I think economy works. And but there's a lot of positive things happening in South America right now. We are large investors in Bolivia as well, and I think most of those markets are going to be opening up drastically. And yes, there's a lot of political risk. Don't get me wrong. There's certainly things to be aware of in terms of the jurisdiction risk of that region. However, in a bull market for commodities, I think every asset has a price, and things are really cheap in those markets. As we see institutions really spread their wings into the commodity space, I think it ultimately they will drive those markets much higher, and they're very small and really cheap currently. So you can own a Brazilian bank, trade 3-5 times earnings, relative to owning FANG stocks with very limited growth at trading at 50-100 times earnings perhaps. And so I'm not really answering your question specifically, but I think Argentina is going to be a little more challenging than the market maybe is, the excitement is currently. But I do think that's a very important political win for South America overall. And I'm really excited about that. I mean, I think Argentina has tremendous growth potential, and if they can only fix the currency problem, create stability on the currency, regardless if it is to either dollarizing the economy or pegging, which I think would be my suggestion would be pegging with gold. Or something along those lines, I think would be a huge shift in the country that could potentially attract foreign capital that has been leaving the country for so many years, and potentially allowing some of the resource companies to go back and invest big capital in the country that could change the whole game there. I mean, so many great discoveries and development stories in the country that could unlock so much value in the near future if those things get out of the way. And so I'm really excited about South America overall. I think that that's one of the best regions in the world today to be focused on.
Excellent, Tavi. I appreciate your nuance in that answer, especially since you are, fairly focused in South America, right?
Yeah, I was born and raised in Brazil, and I had certainly seen most of the corruption scandals and issues, and grew up in a very inflationary era. It's really interesting to me how living in America now and seeing inflation becoming a problem and going to grocery stores and all sorts of things and seeing that developing in the culture of most folks in the US, and people still seeing this as disinflationary, a disinflationary era, to me is just classic of somebody who never lived in an inflationary period. And I would be very cautious of those views that go back 10 years ago. And instead, you should be going back, much further in history and understanding how inflationary eras they actually become quite a psychological impact in consumers and businesses. And I think the gene is out of the bottle here in terms of the U.S. and other developed economies. And this is why I think cost of capital is going to be a big question, because inflation staying high certainly causes cost of capital to stay higher, and that creates the need for investors to look back in profitability and other things. And yes, coming from Brazil, I've never been excited about the country, or I shouldn't say never, but I haven't been excited for a real long time. And right now, I know that the Lula leadership creates a lot of skepticism. Even myself, I'm not a fan of Lula at all, politically speaking, but I break down my investment views versus my political views, and I certainly think that Brazil has never been cheaper in terms of businesses. And regardless of who it is in terms of running the country, I would say that the congressional work, or I should say the politics of the country itself, the leadership in the politics has never been so divided. And so this is, to me, it's actually positive for not allowing a single politician to make so many changes like we've seen in the past. And so I think real estate in Brazil could do very well. I think the currency could do very well. But this is all on the back of a commodity view. And so, obviously, I think Brazil is going to be the best BRICS, and this is why I'm so focused in the country right now.
Excellent, Tavi. Well, I think that's a great place to wrap up for today. Is there anything else you'd like to share with our listeners before we do?
No, I think the thanks again for having me on. If you want to find out more about what we do and our research, you can find more on Crescat.net. We put out great letters, I would say, and really going deep into the weeds of what we think the macro environment is going to look like 5 to 10 years from now. And if you enjoy charts, I would highly suggest to go there and check out some of our work. But thanks again for having me. I think this is a very interesting environment to be that we're living in, and we can say this every time we talk. However, I do mean it. I think that there's some big changes ahead of us, and I think we're going to look back 5 to 10 years from now and think that those things were very obvious. But it's amazing to me, the skepticism in hard assets today, despite all this sort of multi-factor approach of tailwinds that we're seeing to really prop up the prices of that part of the market. And so I'm really excited about all those things, and I think we're going to look back and think those things are obvious. But living in this moment, you can definitely tell that there's no shortage of skepticism today.
Mm-hmm. Absolutely. And that's, I think, where this sector is going to thrive because of.
That's correct. I agree with you. And I can't imagine we're going to go through all those changes without making metals and mining, in particular, much more relevant part of the global economy. And so, it's time to get busy.
Mm-hmm. Absolutely. And of course, for anybody that doesn't know, you post tons of excellent charts at Tavi Costa on Twitter as well.
Yes. Thanks for pointing that out. Appreciate that. Thank you.
Of course. Thanks for your time today, Tavi.
Thanks.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.